for one of our weekly webinars. We have a really great program set up for you today with Kenneth Wolfe, who's going to be discussing a variety of different topics. The title of today is the 4 Wealth Building Blocks for Real Estate. It's going to include information that pertains to generating income, generating growth, and even some tax strategies as well. So before we get to that, I want to just do a quick screen share here with everybody. And I do have just some introductory information that we're going to give you about Quest itself. So let me go ahead and just get this queued up and ready. Let's see. All right. So first point I just want to start out talking about with our webinar is, again, we're here to listen to Ken Wolfe, but we're going to briefly just talk about Quest and who we are. Quest Trust Company is the largest self-directed IRA company in the state of Texas, but we do have a nationwide clientele of over 20,000 investors currently across the country. We have currently under our administration in excess of $2 billion in assets as a whole. We have really, it's more now about 120 employees that we have, and a number of them are credentialed as certified IRA service professionals, which is a designation that is given by the American Banking Association and represents a particular specialty with regard to IRAs as a whole. Right now, currently, we also have, through our investments and our investors, about $350 million in uninvested capital. So that means we have clients who are sitting on cash and they are ready to go, looking for new investment opportunities. Now, just a quick disclaimer with regard to this presentation. First of all, Quest Trust Company here, we do not provide tax, legal, or investment advice. And the purpose of this seminar is purely education.
Sorry to interrupt, but doesn't
What's
look like
that?
your screen is being shared.
It's which one?
We're not seeing a screen share at all, sir.
Oh, you're not?
Sorry about that.
Sorry. Well, I'm sorry, I don't see what's happening here.
Oh.
Here we go.
Oh, you got it?
Oops, hang on.
Awesome, we're seeing it. And
I apologize for these technical difficulties here. Let me just give it one more try. Is there anything that you're showing now?
not yet.
All my slides that jumped ahead?
No, we actually can't see the screen share at the moment.
Technology. I can't get this thing up. How are we looking now?
There we go. Perfect.
Thank you for bearing with me. So as I was saying before, though, again, our credentials are pretty straightforward and, again, speak for themselves. But again, the purpose of this is purely for educational purposes. Quest Trust Company does not offer legal, tax, or investment advice. And again, you always want to work with your team as you are engaging in any types of investment transactions. And that, of course, would include potentially a tax advisor, an attorney, and perhaps even a financial advisor with regard to transactions that you engage in. One thing I do want to make mention of, which we are very proud of here at Quest, is our new client portal. The portal for our clients has really simplified the investment process as a whole. What it allows you to do is avoid filling out forms that you might otherwise consider somewhat unnecessary, but it lets you initiate a transaction by way of the portal itself and permits you to upload documents that are supporting the transaction itself. Now, one thing I like to emphasize when it comes to the portal is that you do not lose the customer experience that you've come to expect from Quest Trust Company. Through the portal, you will still have a specific specialist who is assigned to your transaction. Now, through the portal, you will be allowed to message with that individual. Of course, you can always call them, but the portal is also going to allow you to track the investment progress in real time. So again, it's become a time saver. Anecdotally, I can tell you the feedback I've gotten from a lot of clients has been very positive. The portal is somewhat still being adapted and being updated and made better and better. But right now, it seems to be going quite well, and the response has been very positive. Now, one of our hallmarks is still, of course, ongoing education and networking opportunities. And these opportunities are picking up more and more, especially as we get through COVID. We are still going back live. That's at least the intention and what you will be seeing from us in the near future. Now, one thing I do also want to point out are the ongoing resources that you have that are available through Quest Trust. The primary resources that you can find for our information, of course, is through webinars such as this. But if you have missed this webinar or any others, you can always find them archived on our YouTube channel. Many of them are on our Facebook page as well. And there's always a number of valuable pieces that you can find through our education center on our website. One thing that we're particularly proud of, which has also been a great success over these last several months and has nationwide appeal as well to our client base, is what we call our virtual happy hour. The happy hour itself is moderated and allows individuals the opportunity to talk about the investments that they're looking for, or gives even subscribers an opportunity to talk about investment opportunities that they have for potential investors. So it's always been a great interaction. It's designed where you can just relax with a beer or a glass of wine in the comfort of your own home. And again, be in that position to put it out there as to what you're looking for potentially with other Quest clients. And of course, we are still offering these weekly webinars. We do about 3 or 4 of these per week. And again, the topics range in about anything that you can think of that relates to self-directed IRA investing. So it's always timely. It keeps you up on the latest trends and opportunities. And again, very educational, but you can always find them archived in the sources that I mentioned previously. And now, right now, we are through the end of the quarter, still offering a promotion that's been, again, very well received, but there is a door that's closing on this as the end of the quarter approaches. But this is our rewards for deposit. This offers you the opportunity to derive a benefit for deposits that you are looking to make. So whether that be through an old retirement plan from the employer that you left behind, or IRAs that are kind of stagnant, or that you're looking to potentially get more growth from through an opportunity that you come across, which Quest can help you with, gives you a chance to bring those dollars over and, again, get rewarded for it. So it's a tiered structure. And again, based on the dollar amount you bring in, depends on the credit that you would get to your account. But we're starting at $125, and $125, of course, correlates to the cost of a transaction. So basically, when you bring your funds over, that next transaction is going to be on us here at Quest. And of course, the more you put in, the more your benefit becomes. So it also is a great time if you want to refer a client to us as well. Now, through tomorrow, we are doing a double rewards promotion. So for every client that you're referring to us and that opens a new account, Quest is offering the referrer a $50 credit to their account and a $50 deduction on the opening fee to the person being referred. Now, the program is typically just $25, but again, we do periodically offer an increase to it like we are now. But again, that offer will expire as of tomorrow. So again, if this is the time you've been looking for to open an account, or if you are looking for a person who has not opened an account, then please take advantage of this offer. Finally, let me just kind of give you the information in terms of how to get in touch with us. This QR code will give you the ability to access the IRA specialists in our department. We are the ones who can give you the guidance that you need in terms of the type of account that might be appropriate for you. And again, also help you in terms of the funding process, be it an IRA transfer, be it a 401k transfer, be it a simple contribution. Again, we're here to help. The other things that you have the ability to do with us is give us a message through our chat box. That's always available during business hours. Again, it's through our website at questtrustcompany.com. Feel free to drop in and just ask a question, or again, ask for some follow-up specifically. You can always call us too. We certainly like phone calls and like live interaction with any potential clients or current clients. So the number there is 855-FUN-IRAs. And of course, you can just use email as well to get in touch with us directly. There is a specific email that goes to the IRA specialists. So again, any of these methods, please feel free to reach out to us. All right, that's where my presentation concludes. And again, now I'm going to turn it over to Ken Wolfe. And again, he's going to give you the presentation on the 4 wealth building blocks of real estate. So Ken, are you there with us? We see your picture.
Oh, hold on. Sorry. The wrong button, just like Steve did. There you go.
No, it's okay. You clearly are doing a lot better than I am today. So
no worries. Yeah. So first I want to say thank you to Quest IRA, Steve, and all the Quest Trust folks that we know and love for having me on here today. I appreciate it. Having me on here again, I should say. So yeah, I appreciate it.
Let me just say one more thing. Questions, please bring them in. We have with us today my good friend and office coworker here in Austin, Sarah Shellum. She's going to be monitoring the chat box for us, so you can bring questions in that way, or of course, just submit them through the webinar itself. And toward the end, we will be taking those questions for Ken. So feel free to bring them on. All right, Ken, I'm going to turn it over to you now.
Perfect. Sounds good. Got this up here now. So I appreciate you guys spending your lunchtime with Quest Trust and Wolfe Investments today. I'm Kenny Wolfe. I started Wolfe Investments roughly about 11 years ago. So I've been buying multifamily real estate since 2010, which for those that know or don't know, that was a great time to get into real estate. So it was good timing on my part. I was actually exiting the oil and gas field and on the accounting side. So anyways, it's good timing, but we built it up now to a pretty good sized company. But today we're talking about the 4 wealth building blocks. These are the 4 reasons why we invest in real estate, and all are very important. But we'll go over all 4 today for those that don't know them. So here's a little bit about us, kind of what we do up here. We do 4 things up here. Steve Jobs said a good company can do 4 or 5 things well. Well, we're going to stick with 4. Like I said, we started out with multifamily, started buying that since 2010. To date, we've done over 330 million in acquisitions, over 5 states. So we've done almost 6,300 units in 5 states. We're down to we own in 4. We're in Texas, Ohio, Oklahoma, and Louisiana. We're actively buying in Texas and Ohio. We like both those markets. They've done very, very well for us. On the commercial side, so we added about 4 years ago, kind of the rest of these arms to our company. So commercial, since 2017, we started buying Dollar Generals, Dollar Trees, Walgreens, advanced auto parts, properties like that, put them into a fund. So we're on our third fund right now, and we've got over 30 million in transactions. We've got 20 stores in 9 states right now, but we've got another 5 stores under contract. So that fund's going well. That fund's very good for the commercial piece, is very good for monthly income, if that's kind of what you need in your portfolio. The opposite, what I like to say, that the opposite of monthly stable, boring cash flow is development. So on these properties, obviously, we're going for big appreciation. We're either starting out with dirt, so we do both ground up development, and we've got 2 projects right now, ground up multifamily projects, one in Dallas Fort Worth, and the other across the street from Cleveland Clinic in Cleveland, Ohio, building A-class units there. And then about 18 months ago, we kind of fell into converting vacant or mostly vacant office buildings in downtown cities across the US to multifamily units, which is pretty cool. So repurposing those properties, which is always fun. And then the fourth thing we do is hard money lending. Doing this for a while now, and we've financed other real estate investors acquisitions and single family, multifamily development. We've kind of done it all. So again, those are for folks who kind of want that the least risky and the lowest reward kind of deal. That's your option there too. And like we said, like Steve said, we'll be taking Q&A after this. So if you do have other questions beyond just these 4 wealth building blocks of kind of what we do up here, that would be, those are fine. So bring it on. These are some of the assets that we own in multifamily, just to kind of give you guys a feel for those that are new. We own A-class, so you can see kind of a few of our A-class properties there. We've bought everything B, C, and D. So D being properties you probably don't want to be at during the day. So we've done those properties too, big fixer-uppers. We have in-house property management, and which is very nice. That takes a lot of the risk out of the deal as well. And we've got some access to some specialized financing too. It took us 9 years, but we're a HUD approved borrower. So that kind of gets us into that A-class properties because of the special financing that we get from HUD on there. And these are some options. These are some of the tenants that we have in our triple net fund as well. You can see they're all publicly traded, high credit tenants. The parent companies guarantee the lease. So that's why we do monthly distributions on those, because basically when you buy these, the operational risk is taken out compared to multifamily. You just don't have the big appreciation like you do on multifamily like that we've seen. All right, so let's get into the 4 wealth building blocks. This is why we're here today, right? So you can see them right there: cash flow, appreciation, principal pay down, and tax shield. And we'll just jump right in, but those are the 4 kind of reasons why we invest in real estate. And it's all 4 of those are how we make money. 3 of them, how we make money. 1 is how we save money on investing in real estate. So cash flow. So and this is pretty simple, but it's just, you also hear the jargon cash on cash as well in our business. So that's just the money you get in your mailbox, right? Either through ACH or check or however that shows up, or through your IRA, Quest IRA account. But that's the money you actually see back to you somehow, some way. It can fluctuate or be really steady. It just depends on what kind of real estate you're buying, right? And what's the business plan between that behind that investment. Probably even if you don't use your IRA, some or all of that should be shielded from taxes. Of course, if you use your IRA, it'll be shielded from taxes. But we do get a lot of depreciation on these as well. And then typically these are, folks tend to want to buy to invest in more cash flow heavy properties, the more closer they are to retirement, whether they want to retire early or later. But it's for folks that have already kind of really built up that nest egg already to where they want it. Or there's folks that even if you're young and starting out, you probably want some cash flow in your portfolio as well. On our assets here at Wolfe Investments, they vary widely, but it's all in our investment summaries we put on our portal for our investors. They can, we're buying a asset here on Monday on a multifamily asset out in Amarillo, and it'll cash flow about 8% to investors year one right off the bat, and then it'll go up to averages over 10% over 5 years on there. And then at the same time, a few months ago, we bought a big fixer upper where investors knew going in that it won't cash flow for 2 years, but we're buying it so cheap and turning it around that it'll be a big appreciation play, right? So really dig in and ask the right questions of kind of what, if you're interested in cash flow, what's the timing of that first, the initial distribution, and does that match to the business plan as well? And like I mentioned, our triple net funds, those cash out monthly because they're so stable on the cash flow. So again, do your homework on the investment, and also make sure that investment matches up to your goals on your financial freedom journey. All right, principal pay down. This is the one that's not talked about on the investment return. I feel like it's underappreciated because this is just where we've got either our residents or our tenants are paying down our loan for us, right? So that's the beauty behind rental real estate, is that part of our return is somebody else paying down our loan. Now, obviously, we have to give a service and a product for that, and it's got to be a good one, or they'll move out. But it's definitely a return that needs to be talked about, I think, more, because over time it turns into a big deal. I mean, a 4 to 7% annual return of just equity built up in the property for somebody paying down your loan. If you hold it, 5 years, say it's that 7% mark, that's an extra 35% return that you'll get on a sale. And then, like I said in the fourth bullet point there, you can only, the only way you unlock this one is either through refinance, which will get you part of this unlocked, or sale on the asset as well. Appreciation. This is probably the most talked about type of return. This is what makes everybody smile and happy, right? People want to talk about their home runs, and appreciation fuels the vast majority of those home runs that people like to talk about. So this is where we take an asset and the value's gone up, either by us and or the market. So a lot of times we've seen some cap rate compression, and so that's the market helping us out, the wind at our back. At the same time, though, as well, in multifamily and development too, both of those are more prone to appreciation. And multifamily, you're very much in the driver's seat on that appreciation for the majority of that type of return. And then development obviously is all appreciation. You're starting out with either just a piece of dirt, or to turn into a new building, or repurposing a building and making it a much more profitable asset. And then, this is a good way to really snowball your holdings. So what we like to do up here at Wolfe Investments is on a lot of our properties, we go in, do our business plan, do a cash out refi, pull some equity out, get that back to investors. We shoot for about 50%. As the minimum to get back to investors. So if you, in one of our deals, if it's a fixer upper, we'll shoot to give you back, if you invest 100K, get you back about 50K on the cash out refi, and within 2 to 3 years. That way you have a lot of your money out of the deal, and then we hold it another 5 to 7 years, let it cash flow. That way you can really, you can take that money you get back and then reinvest in something else. And again, that really kind of snowballs your holdings and can really build your equity, your nest egg, and your cash flow quickly. Again, this is just like principal pay down. When we have appreciation and force that up on our multifamily or even in our developments, we can't really unlock the full thing unless we sell it. We can lock part of it on a refi. So those are kind of, how you get each of those 4 building blocks out. I've kind of gone through those 4 pretty fast because I kind of want to get to the Q&A. That's always where the magic happens. So And the fourth one, and then I almost forgot about it, but it is a big deal. Real estate is one of those rare investment vehicles where you're rewarded through tax savings, right? So there's not much else that compares to it on that front. It really, again, the amount of tax shields you get for real estate depends on what type of real estate. So really dig in on that. So like on our triple net funds, we don't get as much depreciation today as we do compared to our multifamily. So you really want to dig on that, and what does that look like, and how does that protect your overall portfolio of investing? The beautiful thing is we've had cost seg. If you guys don't know about that, Google that, cost seg bonus depreciation. That's a lot of jargon, but basically that's been a way to get around you having to use a 1031 as well. So that cost seg bonus depreciation speeds up the depreciation. So a lot of our investors get a write-off about 50% or more of their initial investment on our multifamily acquisition. So, which is really big. I mean, if you invest 100K, you get a 50K write-off. That can really shield a lot of other capital gains or investment income. And again, like Steve said, I'm not a tax professional, so talk to your CPA about your situation. But I've personally have used this, and it's been great to really, again, snowball your investments. It really compounds your returns by being able to use that. And then the big thing everybody wants to talk about is, so we've, obviously there's been talk about killing off the 1031 exchange. Talking to our, other CPAs and other than ours, just kind of talked to a lot of them. They think that's pretty unlikely to go away. I guess 1031 exchange has been around for a very, very long time, and it's talked about a lot as people are trying to get rid of it. But it's so entrenched. I think they think it'll be pretty tough to actually do that. The cost seg bonus depreciation, though, that is starting to phase out in 2023. So basically this year, the remainder of this year and next year, you're going to get probably the best appreciation out of investing in real estate. So rack up as much as you can. We do know changes are coming. Right now, it's been a lot of talk and a little action, but definitely things are going to change. So make sure you stay in tune with your CPA. If you don't have one, get a great one that knows real estate. Because things are changing, and be ready to be nimble and quick. So again, I kept it pretty short today, guys, just to make sure we get to the Q&A. Again, that to me is where the live fire and the magic happens. But this is a way you can connect with us. There's our website, wolfe-investments.com. If you'll go down and click that big red subscribe button, that'll get you on our list of kind of keeping up to date with us. And then you'll be prompted if you'd like to become an investor on setting up a time to talk with myself, and we'll get you in the investor portal if you'd like. That's our email address, investors@wolfe-re.com. If you have any questions like that, please shoot that there. You can find us on Facebook, LinkedIn, and because of COVID-19 back in March, I started a YouTube channel. So I put out a weekly educational video every Thursday. So you'll see those on there, and we've just added a few property tour videos, some behind the scenes footage of kind of run folks through a high level case study on each some of the properties that we've already done, and we're shooting a lot more of those coming up. So you'll see those. But looks like we've got a few Q&As, but if you have any, keep them coming, and I'm ready when you are, Sarah.
All righty, we do have a couple of questions. I'll go ahead and read those out loud. Do you do 1031s into and out of your investments?
We've been asked that a lot. It's not easy, to be honest with you. And honestly, with the cost seg bonus depreciation, it hasn't really been a need because we get so much depreciation. That hasn't really the problem with the 1031 exchange into a syndication, and that's what we do. We bring investors together to buy big assets. Is that a lot of banks don't like ticks, and you have to come in as a tick if you're a 1031 exchange. Also, it's got to line up exactly with your timing, when we get something under contract and all that. So short answer is no. Not typically.
Perfect. John says, isn't multifamily overpriced with the cap compression? Maybe you can touch on that.
Yeah, sure. I mean, we're still finding deals. The past 3 years, all of our acquisitions, I'd say 95% of our acquisitions have been off market. We've been in the business almost 11 years now. We've got a pretty good reputation about doing what we say on the buy side. So we get a lot of first looks on the multifamily front. This year alone, we'll have bought about 100 million worth of multifamily. So we've got a great pipeline. And again, we're in multiple states, right? So that helps our deal flow. But, we tend to buy off market and sell on market. So it just depends on where you're at, where you're looking on the multifamily front. Again, if you can get the off market stuff, that's right now the better way to go.
Yep. The more you look, the more you'll find, right?
Exactly right.
Okay. Here's another one. Can you discuss further the conversion of office space to multifamily? Do you see this a focus of your company in the future as well?
I don't say it'll be the focus. I mean, definitely we've got a lot going on. We bought the Rockefeller building in downtown Cleveland. It's a historic building built by the Rockefellers in 1905. Something's pretty cool. That's got a little bit of a cool factor. And we're pretty sure John D. Rockefeller's ghost is on 16, but that's a whole nother conversation. But they're great. I mean, what we're doing there is taking an asset that's it's underutilized or underpriced on revenue per square foot and taking it to A-class multifamily, which is getting a rent premium. So it is a development deal, no cash flow for the first 2 years, but once we do, we'll be able to pull out a lot of equity. And we're left with this just beautiful A-class, irreplaceable locations. These are all downtown locations. We just picked up another property in Atlanta. We've got a second one in Atlanta coming down the pipeline. And so we've got probably another 3 or 4 after that look like we're going to get those office conversions. It's a construction zone. It's a little faster than ground up because we're starting out with at least walls and a roof at the minimum, but we're getting all new systems in there as well. So new electric, new AC, new, all the MEPs are all new. So we'll have a little bit less, or should be a lot less of repairs and maintenance going forward after we have this basically brand new project on the mechanical side.
That's cool.
I should also mention that a couple of those are also in an opportunity zone. So we've had 2 deals that were in OZs as well. So, which I know some folks get excited about.
Yeah. We've got a lot of people asking how to get involved with you. I'll save those to the end. Do you have to be qualified or accredited, in order to invest with you guys?
So we take sophisticated and accredited investors. We take both, and we take obviously IRA funds or cash, either one. Just nothing in a duffel bag. So
perfect. We have one from Thomas who says, what cap rates are you purchasing multifamily at?
That's a good question. The only issue with that question is I've bought everything from I've bought an 8 cap, I've bought a 0 cap. And going in cap rate to me is not one of the best ways to qualify an investment because it really depends on the investment strategy. That 0 cap we bought, it was so mismanaged. It was 50% occupied. Their expenses were way too high. All these things there was a lot wrong with it. So to me, if you're going in cap rate only matters if you're looking for cash flow right off the bat, you're buying a stabilized property. Today, I mean, we're seeing people pay, 3-4 caps for stuff here in Texas, which is just amazing. A lot of those are out of state buyers, but and they're buying for the cash flow.
Perfect. We have 1 or 2 more questions. We have one from Kumar who says, what are your minimum investments?
Good question. So for our multifamily and our development offerings, the minimums are $50K. On our CRE funds, that is $25K minimum.
Perfect. We have one from Felita who says, where are you looking and where are you finding your off-market deals?
So we own in Texas, we own from El Paso all the way to Longview and everywhere in between. So basically, everywhere in between there. Monday, we're buying a 225 unit deal in Amarillo, Texas. We do have an off-market deal in Irving that we're closing on in 10 days. I mean, so here in DFW, and then we're pretty actively buying a lot in Ohio as well. So we're buying a lot of C-class properties right now in Cleveland, Ohio. We've got about 1,000 units up there of C-class. So we just know that area. We know that type of class product in Cleveland. So.
Yeah, I was about to say, sounds like you like Texas, and then you threw Ohio in there. But no, yeah, if you know the market, go for it. Can you talk a little bit about hard money loans? I am new to the investor world, and what range are the interest rates in?
So on the hard money side, what we offer to borrowers is roughly 2 points and 12%. So we're not the cheapest, and we're not the best terms compared, but we do close. So occasionally we have those from time to time. It's probably our least offered type of offering. But those are the rates on that, the borrowing. And then on our investors, we just guarantee an 8% annual return. We've only had to foreclose once. And so if we do foreclose, investors rack up that 8% annual return. And then once we exit the property, profits are split 50-50.
Okay, perfect. And we've got a lot of questions coming in. I hope that's okay. We have some time. I'm just going to keep on going.
I'm ready.
Perfect. Okay, we have one from John who says, can you let us know what your track record is for the completed deals in Dallas or just anywhere? Yeah.
Yeah, sure. So for our multifamily properties, we've on average doubled an investor's money in 32 months. We've exited over 12 deals. I'd have to look at our tally now, but we've exited a lot of properties. Most recently, we just sold a 188 unit deal out in El Paso. Investors made about 90% of their money in 3 years. So almost double their money in 3 years. And really just depends on the asset though. We still own our first syndicated deal. It's 76 units, but we've refied it twice and pulled out 480% return to investors over that time period. So folks tend to want to keep those. So some we keep for long term, some we sell. It kind of depends on a few factors. One is the actual physical attributes to the property. Is it a chiller, HVAC, pitched roofs, flat roofs? Those kind of things come into play. And then location, rents, and then obviously we look at the market and see what folks are paying. And sometimes it makes sense to take some chips off the table.
Do you do new construction loans?
Good question. I just had that the other day, actually. So we've done that. That was the only time we've had to foreclose, unfortunately, was on those. So we do those from time to time. Since we are in the development game, we're actually seeing a lot of local and regional banks start to get back out there on construction loans. So we're probably if you're going to pay 12% on a construction loan, it's probably not the brightest thing to do. But that's fine. If it works in your numbers, that's fine. But there are lenders out there now actually making pretty good construction loans. I got a call with one at 3:00 today. So.
Perfect. Follow-up question for where are you looking? Can you also explain how you're finding off-market deals?
Really the off-market deals come from brokers. In multifamily, everything comes from brokers, really, even if they're off-market. So we've got a lot of great relationships with brokers, both in Texas and Ohio. We're usually the only person or one of 5 that get a first crack at some of these properties. So that's really kind of how you build those relationships. That's just, proof in the pudding. Are you a good buyer or not? Do you try to retrade on exterior paint, like little, nickel and dime stuff, and then do you close on time? Can you raise the money? There's all these kind of bigger questions that brokers look at. So once you close that first deal, especially, and then the next few, it really kind of snowballs as the brokers put you on their list and reach out to you.
All about those connections. Yep. All right, we're going to kind of wrap it up here. I do see someone asking, this recording, it will be available on our Facebook page and on our YouTube page, so you can always go back and rewatch it. And I'll post that again in the chat for you guys here. But if somebody wants to get in contact with you, if they want to get started, how can they get involved with Wolfe Investments?
Sure. Yeah. So probably the best way is to go to that WOLFE-investments.com, that website. Hit that about 3/4 or maybe 1/3 of the way down. There's a big red button there that says subscribe. So if you do that, that'll get you on our kind of mailer, kind of get you in touch to see what's going on here at WOLFE Investments. And then you'll be prompted to set up a phone call. We have to have that phone call as per the SEC. So make sure you schedule that if you want to get further access to see our offerings that are in our investor portal.
Perfect. Alrighty, well, I'm going to go ahead and close us up. I think Steve had to step into a consultation, but no worries. We are here and we loved having you. Thank you so much for sharing with us these, 4 principles. Oh, here we go. If you have anything else to say, Steve, I'll let you take it away. I just want to let you guys know one last time about our self-directed IRA social. If you're ready to come back out and network with us in person, we do have a couple of special events coming up in our Austin and Dallas office where you can come register for your ticket and network with us live. I know it's kind of crazy right now with everything being online. We are limiting those RSVPs, so definitely be sure to get a ticket and secure your spot. But if you want to come out, come network with us, get some drinks, share some education, we'd love to have you. I'll post those links in the chat.
All right. Well, thank you, Sarah. You wrapped that up very nicely. And thank you, Ken. We really appreciate your time and your knowledge. Again, I think you'll be hearing from a number of different people as there are still some questions that are coming in. And there seems to be a lot of interest in what you have to offer. So with that, I'm going to just kind of wrap this up for us. And Ken, I just want to say thank you again for your participation. And to all of you out there, again, please just keep checking on our events page for other upcoming events. And again, if there's anything you want to catch up on that Ken may have previously asked, just go to the archives. All right. Well, thank you all very much. And we'll see you next time.
Thank you, Steve. Thanks, guys.
All right. Bye.